The first thing I would say, the US markets have a permanent tailwind. You cannot be a perma bear in the markets and be successful. And that's a full stop category. That's because our population has always grown. Doesn't mean it always will. But when population grows, economies grow and markets grow. If you're looking at the single biggest determining factor of future stock market performance around the globe, number one on every investor's list should be, where is population growing? It's not growing in China anymore, that we know. Clearly it hasn't grown in Japan in generations, but our population is growing. India's population is growing. Mexico, Latin America's population is growing. And over long periods of time, that's what happens in markets. They grow. So our markets have gone up, roughly 8.5% a year on average. If you include dividends for decades and decades and decades. Doesn't mean it has to do that next year or next decade, but because of population growth, because of innovation, because of our economy advancing, that's what the long-term averages say. Today's a different story. This is not the market I learned in the 1980s. It's not the market my grandfather taught me about and my dad taught me about in the 70s. This is a very different market because markets always evolve, and technological innovation is enormous. In our lifetime, think of what we've had, Adam. We had the personal computer. Thank you, Bill Gates and the Microsoft operating system. That was the enormous technological boom in the 1980s. What else came along the way? Well, my kids laugh at me because I say the World Wide Web. I mean, the internet came along in the 90s, and that was this second huge technological transformation.
Cell phones, 2010.
I mean, cell phones were the third. And and now, I know we're going to talk about this, but now AI is fourth. But what's interesting, Adam? Each successive, I'll call them inventions, has come faster than the previous one.
So let me ask you, because I want to break down what you said. You talked about markets over the long term. You hear that quoted a lot, that the US markets, the trend is always up. But what a lot of analysts don't explain is that you're looking at a 20, 30-year horizon. You and I have both lived through, people watching this have most likely lived through two major market drops. I'm thinking of the great financial collapse, almost 40% on the S&P 500, and then
58
COVID.
High to low.
Right. There you go. So we've lived through these huge drops. And so when I hear 8.5% return, that's not every year. That's over an average of 20, 30 years. Are most investors that you deal with willing to stick it out 20 years?
When we first meet with prospective clients, and I tell them, they ask me, what question should I be asking you? And I always tell them, ask me what value we add. Ask me why you should hire me. So I go through things like, not only are we a fiduciary, but I'm an accredited investment fiduciary, AIF. Oh, people are like, oh, that's great. They have no idea what that is, but that's okay. And then we do a ton of things. We project out retirement with all these important things like Social Security and taxes and returns and inflation. Like, wow, that's great also. But you hit the nail on the head. Twice in 10 years, 00 to 02, S&P dropped 50% high to low. 07 to 09, 58% high to low. And I look at people and I go, why are you going to hire me? That's the reason you hire me. Those two generational drops in 10 years. Historically, we've added more value during these incredibly painful bear markets. Look, if you think the market's going to do 8-9% a year without these, capitalistic punishing moments, don't hire me. Don't pay my fees. Go buy an index fund. You're going to be great. So the reason we add value, and the average investor said, I'm not going to sit through a 58% decline over 3 years. They would rather give some up on the upside than have to live through a 58% absolute punishing beating over 2 or 3 years.
So let me ask you, just brought up index funds. When I was a young man in my 20s, I was moving jobs. I had a 401k, which were still relatively new because those came about in the 80s. But this is the 90s. And I took a small chunk of change. My brother at the time was a Wharton grad, Stanford MBA. He said, put it in the Vanguard Index 500. I know the dollar amount. I did. I converted it to a Roth in the early 90s when the government allowed that for 1 year. That chunk of change that I dropped and haven't put anything into has multiplied over the last 30 years into it blows me away. How is that possible? Because I didn't add to it. And the question is, shouldn't most people then do what Warren Buffett says and just do index funds if you're looking on a 20, 30-year horizon?
So first of all, great job. Congratulations. You did exactly what a young person's supposed to do. And when young people come to me, I'm brutally candid and I tell them, you don't need to hire an advisor yet. You can, that's fine. But if you just, and for young people, I tell them to do something like 75% S&P 500, 25% NASDAQ 100, set it and forget it, let it alone. You're going to go through some absolute hair-raising declines, but you're really young. Let's say you're in your 20s and you're going to continue to add. You didn't, but you likely will continue to add, and you're going to be fine over time. The older you get and the closer to retirement, the more the consequences matter. So the number one prospective client we deal with is one within 2 years of retirement who says something to the effect of, I've done this my whole life. I've put it into insert name of index fund, or a lot of people use Fidelity Contra Fund because it has a great long-term track record. But now they're worried because they're so close to retirement and they feel like they've been treated well, but don't want to make some kind of catastrophic mistake along the way. If you're young, you're for sure you can put it into index funds, set it and forget it. You'll likely be fine. But the consequences of a 2 to 3 year bear market that hits you for 40, 50, 58%, jeopardizes people's retirement. And that's why a lot of times they think about hiring an advisor.
So now let's talk about the S&P 500. Let's get very microscopic. It's up 15% roughly year to date. We get signals from the Fed that they may do just one rate cut, maybe not. The market being up seems counterintuitive to what we've always witnessed. If there are going to be no rate cuts, the market would fall. What's going on?
So first, and I love the way you brought that up. We're going to unpack it a couple different ways. First, when people beg for rate cuts, like a dog begging for scraps at your dinner table, I tell people, be very careful what you wish for. Why is that? So first, be careful because the Fed cut rates in January of 2001. What happened next? S&P went down 40%. Fed started cutting rates in the summer of 2007. What happened next? 58% high to low. The Fed cutting rates, the late Marty Zweig, whom I admire incredibly, one of the sharpest investors in history, maybe the sharpest investor in history, he came up with the expression, don't fight the Fed. Except, Pete, there should be an asterisk and a caveat, except when you should fight the Fed. It is a horrible adage for people to follow. It's really quaint and charming. Don't fight the Fed. Go ask people who bought in January of 2001 and July of 2007 and how they felt when they lost half of their money not fighting the Fed. So to me, I love when the Fed goes from a rate hike cycle to neutral, which is where we are and have been. We do not need rate cuts to sustain the bull market. Alan Greenspan really screwed. I've said Arthur Burns from heaven is looking down. He thanked Alan Greenspan every day from heaven because Arthur Burns in the 70s was the worst Fed chair ever. That baton got passed to Alan Greenspan, who he and his minions decided that there should be this heavy hand of kind of government, the Fed. We don't need the Fed to sustain a bull market. We don't need the Fed to end a bear market. The Fed is too involved in our markets. They need to let things occur organically. And recessions are a way to punish how capitalism punishes excessive risk takers. It's not the Fed's job to stop recessions and bear markets. You need to punish people who behave poorly so they don't do it again. To your point, the one and done, we came into this year with most people looking for 6 to 7 rate cuts. And I got a lot of heat for saying this, but I said in December and January, I said, I don't know what crack or what drugs those analysts are on, but they're 100% wrong. At that time, we were looking at 2 to 3 rate cuts with the risk being less. And I said it could be 1 or 0. And I think right now, if you look at the 2-year note, which is now roughly 0.5% below Fed funds, that tells you 1 rate cut is likely coming. Doesn't tell you timing, but it tells you the market really wants 1 rate cut. My worry, Adam, and we saw retail sales this morning, and we saw some cooler inflation data last week. My worry, frankly, is the economies could stall, and inflation could not get down significantly below 3, and we're going to have a whiff of stagflation. That's the worst of all worlds.
Let's talk about the worst of all worlds. Should I be concerned, because there's been a couple of articles recently that the S&P 500 and its gains are really driven by just a few companies, NVIDIA, Microsoft, Apple, that outweigh, I think it was like 30%, their impact on the S&P 500. Should that bother me? Or if I'm in an index fund, it doesn't matter. But
Right.
How do I play that? Or how do I invest appropriately knowing that?
I think what we're back to is a market where we have a handful of stocks so the S&P 500, not to get wonky on folks, but it's a cap weighted index. So before people roll their eyes, it just means that the index, the weightings of each stock are determined by how big a company is. The bigger the company is, the higher the weighting in the S&P 500. That's versus the equal weight S&P 500, where every stock has the exact same weight. Should you be worried? You should always worry. I mean, this is investing. This is hard-earned money. It's really hard to earn money, right? And to save it, invest for the future. So I always worry, but this is not atypical behavior. In emerging and new bull markets, the rising tide lifts all ships, with the garbage, crummy stocks, the most levered and really just crappy stuff, that goes up the most at the beginning of new bull markets. And the longer the bull market goes on, the more narrow the rally gets. So at the end of bull markets, you have just a handful of stocks left. It's like if you were in battle, the generals are still alive and the troops have all died. I don't think this is the end of the bull market now, but the easiest money has been made. People are plowing into these AI stocks as if they're a safe haven, which you and I both know. We've been around the block. That's a very dangerous investment thesis. You're going to get punished. In my mind, the question is not if, but when and to what degree. So I would say if a scale of 1 to 10, how concerned am I about NVIDIA, Microsoft, Google, now Apple's back to new highs. So how am I concerned about that? 6 months ago, my concern was maybe a 2. So today, maybe my concern is a 5. More things are creeping in the NASDAQ 100, which is that bellwether index. But I'm not at the point where I think we've got all these red cautionary bells and whistles and lights going off.
Let me repeat, though, if I'm hearing you correctly, if as we get into the later stages of the bull market, and it would seem based on what you just said, we're there because the crap has fallen to the bottom and the money's plowing in, but it's trying to plow into those top S&P companies. Wouldn't that signal we're just about at the end?
No, not so. I know why you said that, because you're looking at just the attribution of what stocks are leading the index, which happens in every maturing bull market. But let me go and say this. At the same time, the New York Stock Exchange Advanced Decline Line, which just measures on a daily basis how many stocks go up, how many stocks go down on a cumulative basis. So that just made an all-time high. It doesn't measure magnitude of some of these stocks. Like when you look at, NVIDIA, you're like, holy geez. Doesn't measure magnitude, but it does measure that on a cumulative basis, all the stocks on the New York Stock Exchange just made a relative new high. Now, that's pretty good. Bull markets do not end that way. They normally end when the indices like the S&P 500 continue to go up and the number of stocks going up and down goes down. We're not there yet. Now, people who want to push back and say, oh, that's nonsense, and they're going to say, well, how about the scarcity of stocks making new 52-week highs? And I would give, that is a problem right now. The number of stocks making new highs has gone down, 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 down. We're at a paltry number, under 100. And while the number of stocks making new lows has gone up, I'm going to argue that right now in June of 2024, the market is internally correcting itself. I think this is a beneath the surface correction, which will end with the indices, S&P 500, NASDAQ 100, finally seeding some gains, and that will set the stage. And maybe that happens in September, October, where we finally see some cracks in the S&P and the NASDAQ 100. But I think that will lead to another rally into 2025. That's the rally. My concern meter could be 7 or 8, but it's not right now because we've seen too many good things in the last couple of months at new highs. But your comments are certainly well taken and thought of. I just think we're early in that proclamation that it's the end.
Right. So let's wrap up. What's the most important thing? It's mid-June. I'm looking at these markets. What's the most important thing you would want us to write about as far as looking ahead? You said September, October, maybe some cracks, but then another rally in 2025.
So first, I would say the single thing you shouldn't worry about, which I've written about all year, is don't worry about the election. Markets hate uncertainty. Whether you love Trump, you hate Trump, you love Biden, you hate Biden, it's a certainty that one of these two guys are going to be the next president. That for the market is a certainty. Doesn't matter how you feel politically. The market can adapt and adjust just like the US Marines, and market will get comfortable with both people becoming president. What you should focus on, to me, the three most important things. One is the 2-year Treasury note. You can look at it you can Google it and look at it every day. If the 2-year Treasury note, which is now about 4.75%, if that somehow goes to 5.5%, the Fed is in a box. You have a huge problem. That would be my concern meter at a 9. 2-year note, 5.5%. Houston, we have a ginormous problem. Number 2, I would say, is the US dollar. Right now, the dollar is basically just going sideways, and the currency markets are multiples bigger than the stock market. If the dollar begins to really get going again to the upside, it's going to put a lot of pressure. That's a safe haven trade. It's going to put a lot of pressure on international investing and put a lot of pressure on US companies. So I don't think that happens, but it's certainly a possibility, not a probability. I mean, I would just say this to now that folks have just piled into those handful of AI stocks, and I get hate mail all the time when I tell people, and this is probably the best advice I can give any investor. If you bought a 5% of your portfolio position in Apple and Nvidia and whatever stock, Google you want, good, sound, professional portfolio management says, if a 5% position becomes 8, 9, or 10% of your portfolio, it's a really good time to peel some back. If it went from 5 to 10%, sell 1%, get back to 9. If it went a little higher, sell another 1.5% or 2%. Do not let 1 or 2 stocks get to be an outsized weighting in your portfolio, because we do know historically that latecomers and when stocks go vertical, you're going to get punished. And do it from a position of strength. Don't start selling when Nvidia is down a couple $100, $300 in a couple of days.
What's the adage? How did you become a millionaire? I took my profits too soon.
Exactly.